I just want to thank everyone for joining us this afternoon. My name is Tony Zhang. I run the product strategy team here at OptionsPlay. Today, we're going to be talking about what's your next options play, because we've had a crazy few weeks in the markets, and we want to make sure that you're applying the appropriate strategy for different market conditions. So today, we're going to be talking about trading verticals, all different types of verticals, because it's our favorite strategy, because you can use them in all different market conditions. You have limited risk when you're trading verticals, which is an important piece to understand when you're adding these types of strategies to your portfolio. And what we really want to do is make sure that we understand the difference between trading debit versus credit spreads. These are the most popular strategies by both everyone here. So I want to make sure that we understand each one separately and know when to apply them correctly. So before I get started, let me just ask a quick poll here. You can answer the poll on the right. It's just asking if you're new to options trading, or if you're starting out, or if you've been trading for a while, just so I get an understanding of who's in the room. Looks like most of you have been trading options for a while, so that's okay. Okay, so about 75% of you guys, or 80% of you guys, have been trading for a while, and about 20% of you guys are new, and that's okay. We're going to go over what these strategies are, how to construct them, and getting into the details for those of you that are new. And for those of you that have been trading for a while, we'll really use OptionsPlay to go through some real life examples, especially in this current market condition, show you guys some real examples that you can actually use for using verticals for your trading. Okay, so let's go ahead and end that poll. Great. So let's just quickly jump into what we're talking about. I'm only going to spend about 15 minutes using these slides, maybe even a little less time than that. And then what I really want to do is spend the time using OptionsPlay to show you the difference between trading these different vertical spreads and how you can apply them appropriately for your accounts. So first of all, we'll talk about what are vertical spreads. I'll talk a little bit about what are debit spreads and what are credit spreads, what the difference between the two are. We'll talk about when to use vertical spreads, because it's very different between credit versus debit spreads, to understand when you should use them. And then lastly, we'll talk about how to trade them effectively in your account. So the different things, the different nuances between the two strategies, understand how to manage risk, understand when to enter these types of trades, what type of market conditions to use them in. We'll talk about that. And then lastly, like I said, we're going to use OptionsPlay to show you some actual real life examples and show you real differences between credit versus debit spreads, so that you know how to use them effectively in your portfolios. So let's just start real quick about what are vertical spreads. It's really simple. We break them down into bullish and bearish vertical spreads, and there's a difference between debit versus credit spreads. I'm going to start with the debit spread. So if you're bullish, you can trade a bull call vertical. This is the debit spread that you can use to take a bullish view on an underlying stock or ETF. If you're bearish, you would trade a bear put vertical. And then I'll talk a little bit in the next slide as to how you actually create these. I know I have a lot of questions here, but keep in mind that we'll answer those questions towards the end. You can, I generally prefer that you wait for your questions to the very end, and then we'll answer all of them at the very end during our Q&A, okay? So talking about debit spreads, you have bull call vertical and bear put vertical as the two debit spreads that you can trade if you're bullish or bearish. And then if you're trading credit spreads, you can trade a bull put vertical, which is the bullish credit spread, or you can trade a bear call vertical, which is the bearish credit spread. Okay, so let's just jump right into what these actually are. And before I get into the specifics of each one, I do want to talk about vertical spreads are effectively option strategies that give you a predefined risk and reward before you get into the trade. And that's really why we love trading them, because as traders, we always want to know what is our potential risk versus our potential reward before we get into a trade, so that we can properly plan for the trade. We know exactly how much we're willing to risk. We know how much potential reward there is on a specific trade. That's the best case scenario you have with trading. If you're trading something where you have defined risk, but you don't know what the reward is, or vice versa, that makes trading a little more difficult to plan for. So that's really why we like trading vertical spreads. And in this particular case, I'm going to use a fictitious stock XYZ that's trading at $100 to show you a little bit about how to define what is a debit versus credit spread. So we prefer trading debit spreads here at OptionsPlay. Especially myself, I prefer trading debit spreads. There isn't one that's better than the other, so I'll just talk about what are the differences between the two. So when we talk about debit spreads, these are strategies that typically have high reward to risk ratios, and they typically come with low probabilities of profit, okay? I'll talk a little bit about that in a second, about what that actually means, because that's a really important thing to understand, the relationship between reward and risk versus probability, because I have a lot of people asking me, why do you trade strategies that have only a 30 or 40% probability of success? Why don't you trade strategies that have higher probabilities of success? And the reason is because of the trade-offs between risk and reward and probability. But I'll get into that in 1 second in one of the later slides. I'm just going to talk about number one, how to define or what is a debit spread. So when we're bullish and we want to trade a debit spread, we call these a bull call vertical. So in this fictitious example with a stock trading at $100, this is where you're buying an at-the-money call or buying a 100-strike call, and you're selling a higher call, such as a 110 call against it. So you're buying a call, and you're trying to generate some premium against it by selling a higher call. If you're bearish on a specific stock, XYZ, you would buy the 100-strike put, and then you would sell a lower put, such as the 90-strike put against that. And this gives you a bearish view using put verticals Conversely, with credit spreads, it's the exact opposite. You have low reward to risk ratio, meaning for every dollar you're risking, your potential reward is less than that $1. However, what you get with that is you get a high probability trades. These are trades that typically have anywhere from 60 to 80% probability of that stock, of that strategy being profitable, but you trade off a low reward to risk ratio for that. So an example of this particular trade is if you're bearish, a bear call vertical is where you're selling a 100 strike call and then you're buying back a 110 strike call. So you're buying back a higher strike call. And we'll talk about how to construct this in 1 second using OptionsPlay. And conversely, if you're bullish and you want to trade a credit spread, this is where you would sell that 100 strike put and then buy back a lower put, a 90 strike put. And that gives you a bullish spread using puts, which generates a credit when you're trading these. So let's talk about, and this is the one thing that I really want to talk about. What is the actual trading difference between credit versus debit spreads? Because we can talk all day long about how to construct them and different things, but there's a whole different mentality to trading debit versus credit spreads. And it's important to understand that before you decide which one's best for you. Okay, so I talked about debit spreads are typically lower probability trades that typically have better risk to reward ratios. So here's an example. Debit spreads, typically you'll have about 40% of them being winners and maybe 60% of them being losers. And a lot of people ask us, why would you bother trading something like that? And the answer is because for every dollar you risk, you're generally speaking trying to gain more than double that amount on the trade. So you might be risking $50 to try to make $100. That's why you would accept a lower win ratio or a lower hit ratio, because you're getting rewarded on the upside when you are winning more than what you're risking. So what that actually means is that, and I've put together a string of 5 trades to give you an idea as far as what it feels like to trade debit spreads, is you might win only 40% of the time. So here are 2 trades out of 5 that I'm making $100 on, and 3 out of those 5 trades where I'm losing $50. So most of the trades I'm losing a small amount, and on the winners that I win a substantially larger amount, which gives me a total net profit of $50 at the end of these 5 trades. Okay. Conversely, let's take a look at what it feels like to trade credit spreads. These are types of trades where you have high probability of winners. So we talked about where you might have 60, 70, 80% winners. So most of your trades are winners, but you're risking substantially more on the trades that you're losing. So here you have a risk reward of 1 to 3, which is not very good. And this is personally why I don't love trading credit spreads, because I don't want to risk more money than I'm going to make on a specific trade. But everyone has their own personal preferences. Each one of us are a little different. So some people like to win a lot of small amounts, and then they're okay with losing larger amounts when they're wrong. So here, the same 5 trades, most of the time I'm going to make $50, a small amount. And then the one time that I lose money, I lose substantially more. I lose $150. As you can see, over 5 trades, I still at the end come out with the same result where I'm making $50, but it's just a different way of getting there. So it becomes more of a psychological thing. What is more easier for you to wrap your head around? Losing more percent of the time, but when you win more money, or taking small wins along the way, and then potentially losing a lot more on the few trades that you do lose. Like I said, that's one that's better than the other. It really comes down to personal preferences as to whether you prefer the debit spreads versus credit spreads. But it's important, I think, for everyone to understand the difference between the two before we move on and talk about how to go about trading these. So what I really want to talk about is when to use these vertical spreads. Now that we understand the difference between the two different strategies, I want to talk about when is the best time to use these strategies. So when we're talking about debit spreads, this is really useful when you're expecting a large and quick move in either direction, up or down. Okay, this is really something that you would want to use if you're expecting a breakout or you're expecting a rebound off of a support or resistance level. These are typically the times that you would use a debit spread, and we'll go through some real examples in a few seconds using OptionsPlay to show you when you can use these strategies, and they're typically used in lower volatility environments. So an extremely important time, important thing to understand here is that debit spreads are only useful when you expect a large and quick move. Okay, that's the key. That's the key here. So if you think a stock's going to move a little bit, or you don't think it's going to move a huge amount, debit spreads may not be the right strategy for you. Conversely, on credit spreads, this is kind of the opposite. This is when you expect a neutral or modest move. So if you don't expect the stock to move a lot, you think it's going to stay where it is, or that's really a better time to trade credit spreads. You can typically use them for those of you that are technical traders that use the charts for your trading. This is typically where if you're using any type of overbought or oversold technical indicators, whenever a stock moves into overbought or oversold conditions, this is the time to consider using your credit spreads. Because when something's overbought, it doesn't necessarily mean it's going to come back down. It just means that it's unlikely to continue to move higher by much, much more. So these are the times that you would typically use credit spreads. And I'll go through some examples of this as well, especially in this current market condition. There's quite a few credit spread opportunities right now. And these are typically used in higher volatility environments. Now, I do want to point out is that a lot of people have brought to my attention that they feel that they only want to trade debit spreads in low volatility environments and they only want to trade credit spreads in high volatility environments. But what I want to say is that based on empirical research, that's not always the case, meaning the opposite is not untrue. So you can still trade debit spreads in high volatility environments, and you can still trade credit spreads in low volatility environments. It just happens to be that low volatility environments are the best time to trade debit spreads, and high vol environments are the best time to trade credit spreads. But it doesn't mean that you can't trade them in other environments either. So I do want to point that out. Okay. So let's talk about how to effectively trade debit spreads. Okay, so like I said, debit spreads are for those of you who expect a large quick move in a specific direction. So this is typically where you want to time your entries with an expected large move like we talked about. And this type of strategy, risk management, is really key. And what you want to do is you want to cut your losses if the move simply doesn't materialize. So if you expect a breakout or you expect the stock to bounce off a support resistance level and it kind of just hangs there after it breaks above the resistance level or doesn't really move anywhere, that's the time to move on, meaning cut your losses, move on. Your your trade in the debit spread should be linked to the move in the underlying stock. If you're not getting the move, get out of the trade. Okay. And some of the rule of thumbs that you can use when you're trading these strategies is you want to cut your losses if you've lost more than 50% of the premium you've paid on the debit spread. So if you paid $1 for a spread and it's trading at 50 cents or lower, cut your losses, move on. Same thing on the upside. If you've gained 75 to 100% on the upside, that's a time to start taking profits. If you're trading multiple contracts, you can take partial profits at 75 to 100% gains. So if you bought a spread for $1, it's now trading at $1.75 or $2. That's time to start protecting your gains. Excuse me, and start taking some profits on at least partially on some of your trades, if not all of it. And the one thing I do want to explain about debit spreads is that this type of strategy, you almost always exit the trade before expiration, either at a gain or a loss, but you always exit this trade at before expiration. This is not the type of strategy that you would typically hold all the way till expiration. Okay, so make sure that when you're trading debit spreads, you don't hold them to expiration. You get out prior to it using one of these two rules. Either it's going against you and you got to cut your losses, or it's going in your favor and you got to take profits. Moving on to credit spreads. Same thing. Risk management is also key when you're trading credit spreads. Trading credit spreads, it is a little trickier because of depending on how much credit you actually receive. So we'll talk a little bit about that. But talking about credit spreads, when you're trading credit spreads, depending on the underlying stock or ETF, you want to time the entry of these trades with tops and bottoms. So when you feel that the stock is about the top, that's when you would trade a bear call spread, and if you feel the market is bottom, that's when you trade a bull put spread. And you typically what you want to do is you want to string these calls and put verticals together. So whenever the market tops, you want to sell one of these call spreads, and when the market bottoms, you want to sell one of these put spreads. It's really effective way to essentially, as a technical trader, to trade every top and bottom without necessarily having to have a very strong directional view. And that's really why a lot of people like to trade these types of trades, credit spreads, because the stock doesn't really have to move anywhere, and you can still potentially profit from this trade. However, managing these trades, meaning looking at the exit strategies, it's usually a little bit trickier because it depends on how much premium you're actually collecting. And there isn't a good rule of thumb here. So the best thing you can use is take a look at how much premium you're receiving in relation to the vertical width. And the vertical width simply refers to the distance between the two strikes. So in the example that I was giving before in stock XYZ that's trading at $100, if you're trading a vertical that has a 10 point width, that means your vertical width is $10. So if you're receiving less than 20% of that $10 in premium or credit for the spread, then you want to cut your losses when the trade is at anywhere from 100 to 200% unrealized loss on the particular trade. And this number gets stretched even further if you're only collecting less than 10 or 5% of the vertical width. But I won't get into some of those extreme examples because most people don't trade them. But if you do, you can always ask questions at the end. So when you're trading these, when you're receiving a small amount of credit, that means you're trading fairly far out of the money credit spreads. You want to cut your losses when you've lost 1 to 200% of the credit that you've received. If you're receiving more than 20% of the vertical width, so if you're receiving more than $2 on that $10 vertical, then you want to cut your losses somewhere between 75 to 100% of the credit that you've received. And there isn't a fast rule of thumb with the credit spreads as there is with debit spreads. And that's personally why I also don't love trading them, because there isn't a hard and fast rule that I can always stick to. It kind of varies depending on how much credit you get and how far out of the money a stock is from the credit spread that you're trading. So it makes managing them a little trickier. But the one thing about credit spreads is that taking profits is typically done by holding the trade to expiration and letting the credit spread expire worthless. So if you receive $2 on a $10 spread, you generally want that spread to expire worthless, so you keep all $2. So that's typically the rule on how to take profits on a credit spread. So this is also personally why I don't love trading them as much, because there's a lot more work around managing them around expiration, especially if it's close to being in the money. You can't just let them expire worthless, or you can potentially own the stock or be short 100 shares of that stock. So there's a lot of those things that you typically have to worry about around expiration when you're trading credit spreads that you typically don't worry about when you're trading debit spreads, because you typically get out of those before expiration. So let's just go ahead and start looking at some real examples now that we've talked about the differences between debit versus credit spreads. We talked a little bit about the differences of when to actually trade them, and then what are the rules around managing them once you're in them. So let's look at some real examples here. I brought up QQQ today, the NASDAQ 100 ETF, the technology ETF here. And the only reason I brought it up here is because, we've had this huge sell-off over the last few weeks and then a huge rally subsequent to that. And the stock has really been the markets have really been very steady around this area over the last few weeks, and it hasn't been able to get above that 167 resistance level, which has been a bit of a resistance since last week. So depending on, and this is by no means, a solicitation to trade a bearish trade on this particular stock or ETF, but I simply think that perhaps the markets are getting a little heavy and it might be turning back down a little, maybe to 160 on the modest level. I think it could hit this 160 support level. And then if things really get ugly, if the Fed raises rates faster than we expect, or inflation gets a little out of control, I can easily see this back at 155 level. So this is a bit of an opportunistic trade, but depending on how you feel about the markets, if you simply feel that the markets are toppy here, or if you feel the markets may be headed lower, this is ripe for potentially both a debit or a credit spread, depending on how bearish you are on the markets. Okay. You could also be completely opposite. You could become bearish on this particular trade. So I'm not arguing one way or another. I'm just using the Qs as an example here. So if we feel that the markets are topping and it's going to roll over a little, let's take a look at trading both a credit versus debit spread and see how they play out. And I think this is a really good example to show you guys here. So by default, when you click on I'm bearish, we're always going to show you these three strategies: shorting the stock, buying a put spread. So let's compare trading a debit spread versus a credit spread. So I'm going to set up the credit spread here in the middle. Let's take a look at some different strikes here. I'm going to pull up some strikes here and take a look. Okay, let's take a look at these. Okay, so I have set up here the debit spread that OptionsPlay defaults to, and I've also set up a credit spread here for us to look at. So notice one thing: when we're trading these debit spreads, I'm risking $281 to potentially make $769. These are the types of numbers that I personally feel more comfortable trading with. Everyone has different preferences, so it's okay. This is just personally what I prefer. I prefer to risk less to potentially try to make more if I'm right in my analysis. Conversely, if you were trading this credit spread, your max reward is $127, but your max risk is $223. So you're going to risk more if you're wrong on this particular trade than what you can potentially make. And that's just personally not what aligns well with me. But everyone has their personal preferences, so let's take a look at these two trades and see how they perform. So one thing I want to point out is the stock's at 164.80 right now. So what happens if the stock market does nothing and it stays flat, which is perfectly possible? If that was to happen here, if I traded this credit spread, I would make $127, the full credit that I would receive by selling this call vertical, this call credit spread. I'd make my full reward $127 if the stock simply stays where it is. So that's really why a lot of credit spread traders like to trade this, because they may not know where the markets are headed. They just think the markets are kind of stable. It's not really going anywhere. I'm going to sell a credit spread and I'm going to receive this premium, which is perfectly fine. And as you can see here, if you had bought this debit spread like me, the trade that I like, I'm actually losing money here. I'm losing $231. Not a good example, right? So again, the debit spread is only for if you're expecting a large move in one direction or another. That's the only time it makes sense to trade a debit spread. So now let's talk about, I think the stock can modestly move down to at least 160. So let's say what happens if the stock goes to 160. Here I make still the $127 credit because that's the most you can make on the credit spread. But here on this vertical, I'm making $269. Moves modestly in my favor. The debit spread starts to become more profitable. I'm going to make more money trading this debit spread, even if the stock just moves $5 lower. Okay. Now, typically when I'm trading these type of debit spreads, I don't just expect a small move. I'm expecting a large move. I'm thinking that perhaps there is a possibility that this stock rolls over a bit down to this 155, 160 support area, which we were just at 2 weeks ago. So I don't think it's crazy for the markets to retest that area. So if, let's say I think the stock's going to go to 155, here I'm still only making $127 no matter how far down the stock goes. I'm limited to that $127 when I'm trading this credit spread. But when I trade this debit spread, I make $769. This is where I realize the full potential of my debit spread. Okay, so you should only trade this if you feel that the markets are going to move substantially lower, which in my opinion, I don't necessarily know that it's going to move that, but I do think that that's a distinct possibility. And as long as I believe that there's a distinct possibility, that's when I will trade these debit spreads. So as you can see, if I'm correct, I make a nice 273% return on my debit spread. If you had traded the credit spread, you would only make that $127, the full credit of that spread. But like I said, it's a different trade, meaning you would only trade this debit spread or this credit spread if you think the stock's going to stay where it is or move a little bit lower. So if you think it's going to move down to 164, 163, 162, you would typically trade the credit spread because that will give you the full credit even if the stock stays where it is. You wouldn't trade this debit spread because you would not make much return here by trading a debit spread. Okay, so this is just a real example of the difference between trading a credit versus debit spread and when you would potentially use one of these two strategies. Okay, so now that we've taken a look at a bearish example, using the current market conditions, I want to bring up another stock. This is a stock that a lot of you are trading, NVIDIA. So I wanted to bring up NVIDIA because this is a stock that currently is near its market tops, but a lot of people are very, very crowded in this stock. A lot of people are long this stock. So depending on which side of the coin you are, you can look at trading these two. You can look at trading debit versus credit spreads a little different. So let's take a look at NVIDIA. Let's take a look at trading the difference between trading a credit spread versus debit spread. That's bearish. So if you've never used OptionsPlay before, you should definitely take a look at the strategy constructor because it allows you to construct all different strategies, including the debit spread versus credit spread. So let's move the strikes down some, which is really what we're looking for. So here what I've done is I've constructed a credit spread versus a debit spread. And I have not looked at the strikes. I'm not saying that these are the strikes that you should particularly use. I've just selected some random strikes just for illustrative purposes here, just to give you guys some ideas. So here again, I have the debit spread. This is the type of trade that I would trade if, let's say, I feel that NVIDIA is going to make a quick move higher, depending on who you are and depending on if some of you follow Bitcoin. You might think that NVIDIA still has a lot of room to grow. It's only trading at 51 times earnings. It was trading at 100 times earnings not too long ago. So there's plenty of room for upside on a stock like this if you're bullish, but also some of you may feel that maybe you're bullish or you don't think it's going to move much lower, but you also don't think it's going to move much higher, and that's when we might want to use the credit spread. So let's take a look at the two. So when you're trading the debit spread, like I said, I'm risking about $1,000 to try to make $2,100 if the stock does take off. So if you are a bullish view, if you feel that this is near its support and you think it's going to make a nice rally higher, you might want to consider the debit spread. If you feel that the market is topping and it may not move much higher, but you don't think it's going to move lower, then you would probably want to take a look at the credit spread. Here, you're going to potentially make up to $320 on the credit, but if you're wrong, you're risking $680. So let's take a look at these two strategies and kind of how they perform. So number one, I said if the stock stays where it is and it doesn't really move anywhere, so let's say what happens here, I make the $320 profit or make the full $320 credit. I keep all of that. So if the stock stays where it is and doesn't really move anywhere, I make $320. Here, if I bought this debit spread, I actually lose most of my trade. So I paid $1,090. Here, I lose $939 if the stock stays where it is. So if I think the stock's going to stay where it is, I would not trade one of these debit spreads. Now, let's say the stock moves considerably higher. Let's say it moves up to 250. So even at 250, I'm going to make the 320 credit here, but I'm really still actually just about breaking even on my debit spread. So this stock really needs to move to at least 250 or higher before my debit spread even makes any money. So let's say what happens if the stock moves to 260. So the stock moves to 260. Here, I'm going to make $900 in profit or an 83% return, versus here, I'm still stuck at the 320 because that's the maximum amount of money I can make and trade this credit spread. So the stock really needs to take off substantially. Let's say it moves up to 270, so $30 higher. That's when I'm going to start realizing my real potential on trading these debit spreads. So again, only if you feel that the stock's going to make a significant move in one way or another, that's when you would want to trade the debit spread. If you feel that the stock is kind of where it is and it may not move very much, that's when you want to trade the credit spread. Now, conversely, if let's say the stock moves substantially against me, you're going to lose substantially more money than the credit you're going to receive on a credit spread. So here I'm going to make $320 if the stock stays where it is. But if the stock starts moving lower down to 220, which is just where it was a couple weeks ago, here I'm going to risk almost double the amount or more than double the amount that I'm going to receive in the credit if I'm trading that put vertical, or if I'm trading that credit spread. So it's really important to understand the difference between the two, between the debit versus credit spread, because a lot of people come to me saying, hey, I really want to trade credit spreads because it has a higher probability of profit. And that's absolutely true. But as long as you understand that when you're wrong, you typically lose a lot more money. And if you're okay with that, go ahead and trade the credit spread. But also keep in mind, make sure you know when is the appropriate time to deploy these two strategies. There is a difference, and managing the trades themselves once you're in the trade is also very different within the two. So make sure you understand that. For those of you that are on this webinar, at the very end, I will provide the slides to you. So if you want to use them as a reference, feel free to do so. And this webinar is recorded so that if you guys have any questions or if you guys want to take the time to review the things we've went over, you can always use the video recording to help you do that. So with that, what I really want to do is bring this back to just to conclude and talk a little bit about the difference between all these spreads. Make sure that you understand the difference between trading debit versus credit spreads. They are very different. The biggest thing to make sure you understand is the relationship between probability versus risk reward. Knowing the difference between the two really helps you pick which strategy is best suited for your kind of trading philosophy and trading psychology, depending on how you typically like to manage your risk. And make sure you understand when is the proper time to cut your losses and take profits on both of these strategies. Like I said, trading debit spreads is a little easier to manage because they're clean and easy stop loss and take profit places that you would typically use when you're trading debit spreads. When you're trading credit spreads, it's a little trickier because you typically take profits by holding them to expiration, and cutting your losses really depends on how much credit you're actually receiving. And there isn't a hard rule of thumb here. So it really kind of depends on how much credit you're receiving. So make sure you understand those differences before you jump into these two strategies. So I hope everyone has found this useful. So at this point, what I will do is I will open this up for Q&A.